All right, our favorite part. Wrap up and predict.
Whose favorite part?
Mine.
Not my favorite part.
I'm tired of predicting.
Wrap up and predictions, always fun. I'll just remind everybody from last time. So last roundtable predictions, Jason said sticking with rates higher for longer, tech pressure, and higher volatility. We get a little bit of volatility. We've had a little correction, and we're getting a little bit of that. There's been a little bit up and down.
333.
I'm gonna give you 1.5.
I'm a major league baseball player.
1.5.
Yeah,
That's a really
not
good
bad.
average for major leagues these days.
Kyle, value coming back. Value's not back yet. Fixed income strong. Mortgage rates decline.
I guess you could argue it's back, just not as good as tech.
Yeah, and listen, some of these predictions, the way we think about markets, it doesn't mean it's going to happen in 3 months. So I will say that. A lot of the stuff that we're thinking is longer term, because again, that's what we're investing for clients, a little bit longer term. It's not a 3-month investment. I said, I've been staying with this one, but I think if you get it right, you can stay with it, right? You just can stay with the same one.
I guess.
No rate cuts in 2024. And so far, we're no rate cuts in 2024, and looking like, again, we put up a chart that says 1 to 2. I think that might be a little wishful thinking by the market. So that was mine. And then Chris said value over growth since the last time, and then a little bit lower mortgage rates. And I did look, mortgage rates are right about the same.
They're exactly the number. It was
Exactly the same.
It was 694 last time, and it's 694 now.
694.
So that was an 0 for 2.
Yeah,
Because value has not beaten growth. It's not close.
I know.
It's how you phrase it. Is it back or overgrowth?
Yeah, that's why you went coming back.
Coming back.
Yeah.
All right, Jason, you got anything?
I still think the Fed funds rate can stay where it's at, but mortgage rates can come down. It's been a while since I looked at it, but I recall that mortgage rates are typically within a certain 1%, or maybe is it 1% or 2% of the 10-year. But it usually hugs within about a point. But then we got all wacky there for a minute because the banks didn't know where rates were going, and they didn't want to be caught. And so there was a huge dispersion between where the 10-year Treasury was, the 10-year government interest rate, and where mortgage rates were. So it's likely, as things normalize, that the mortgage rate could come down back to historical gaps between the 10-year. But I'm still kind of in the camp now that this higher for longer. It seems like this 3% inflation is like the new normal. They might be shooting for 2%, but I don't know where they're going to find it. And so they need to see the inflation coming down in order to cut rates. And I don't think they're going to get what they want. I think we're waiting on when's the next hike or cut? September, or at least that's when inflation data comes out. I think.
No, we got a couple more weeks here. We're in late May now, so the next they meet every 6 weeks. So
we get
next
monthly
meeting I
inflation
think is
data,
3 or 4 weeks away.
But I think we've got inflation data coming out pretty soon, and if those numbers are not lower than expectations, they're going to have a very difficult case to cut. And I think everyone's waiting or expecting the market to cut rates, well, just because we keep talking about it. Oh, they've got to cut rates, but I mean they don't have to. And so I still think higher for longer. I think that's going to kind of hang around. It wouldn't surprise me. Not that I think people should alter their investments, but it wouldn't surprise me if we do have some more volatility, only because we haven't had any in a while, and we usually see ups and downs and variation and ebbs and flows. And we've had low volatility for a while. I don't know what potential black swan could cause it, but volatility doesn't necessarily mean the market's going to be in a sustained downtrend or anything like that. It just means, the seas have been calm for a while.
Sure.
And maybe we'll go through a period where they aren't. I have no idea what would cause that, but it wouldn't surprise anyone if the volatility index went up a little bit. But I'm done calling tech. I don't know where that's going, man. Who knows?
Well, if things
NVIDIA to the moon.
If things stay the course.
There's your top.
The interesting thing that NVIDIA I don't think has been doing that I think they might be in the position to do now is start swallowing up a lot of smaller companies. And just using the stock as currency because it's
now they're going to have more shares.
They're going to have a lot more shares.
10-to-1 split.
I don't think that makes any more value.
I think that helps it.
Just got to use 10 times as many shares to buy the next thing. But I think that probably ends up helping out smaller companies as they get bought out, investors in smaller companies as those companies get bought out because they'll have huge growth rates too. And so my guess is that's probably next in part of the cycle is just more M&A activity.
Microsoft did that for a long time. And now if you look at Microsoft, if you could go look at a chart
So is Google. So is
of
any of these companies.
like when you buy Microsoft or Google, you're almost like buying a mutual fund. Of all the companies they've consumed over the last 20 years.
Yeah, no question.
That's a good one because if rates do stay higher, that affects cost of borrowing for growth companies, and it encourages the bigger the behemoth growth companies to just buy those companies out.
Mm-hmm.
And then
they're not short on cash either.
They're not.
They got cash. But the shares are worth a lot more.
True.
A lot more. Next Fed Fund meeting is July 11th and 12th. So, but we could pull your chart back up and see, but I think there's basically zero expectations that they're going to raise or lower and going to do anything.
Again, they just kind of keep kicking the can down the road as far as expectations of a cut. It's like now they're seeing, they're not cutting. Well, but maybe later in the year. Because again, longer, who knows what's going to happen. But at this point, the way things are going, they're not cutting rates.
Well, they're not taking a lot of heat either. Like there's not a lot of pressure on the Fed to do anything.
Going up.
Well, not just the stock market, but again, housing market's held up fine.
Yeah.
Job market seems to be holding up just fine. There's not a lot of pressure. Now, there'll be weird political pressure probably at the end of the summer.
That's the interesting part.
Yes.
So that's the thing that people have talked about a lot, and that's the only thing I would say is that from an economic standpoint, there's no reason to cut rates. It'll be interesting. People, again, I've read this. I'm not a political expert, but it seems to be that the Fed and all of the government entities are getting a little more politically motivated nowadays. And if the Fed ends up cutting rates for arbitrary reasons because there's an election, then there's a little bit more. They're supposed to be completely separate. Like literally, they don't care who's in office or what party or whatever. We do what's best for the economy and the country, but it seems to be a little crossover nowadays.
Yeah.
Kyle, anything?
Time will tell.
Oh, so if you're wrong, you're not wrong. You're just early, right?
You're just early.
Yeah. Okay.
You just keep saying it.
Yeah. Right. So, I do think mortgage rates are still going to come down. I think we have seen that rate hasn't changed from our last meeting, but there's still some volatility. There's gone both directions a little bit, come down and back up. So I think those will be lower, probably within that 3-month window, even though we are longer term. And I do think value is going to contribute more than growth still. Not more than growth, but start contributing as well. I still think growth is going to outperform, but I think we're going to start getting that spread between growth and value is going to get smaller. And I think that's something that has been overdue for about 2 years now. So,
what do you think on this? This for all you. What do you think on the difference between megas and smalls? Does that keep going? I don't know how that trend continues.
That's a good question.
I think short term it will, right? So if we're doing this between now and our next roundtable, I don't think there's going to be a huge correction. But over time, I think it's going to revert back to the mean. I think the small and mid caps have to start growing.
Unless the top 7 are all just going to be worth $10 trillion and there's nothing left.
That would be bad.
But I don't think that's going to happen either.
Well, then but how much is that tied to interest rates too? And borrowing power for growth for smaller companies.
Right.
So
using the AI word again, because you could see where the 7, not even 7 anymore. That was a term that got coined, even though the names have been changing. But let's just say the bigger tech companies that were kind of the tip of the spear with getting into the AI and doing these language models and buying the chips and doing all of that. You could see why now, in hindsight, why they kind of led this. But now you might see a trickle down where companies like Costco and McDonald's and Eli Lilly and all these other companies are starting to input it, started to influence it, and started to use it in their day-to-day business. So you could see some of those other styles of companies playing a little catch-up. Not that the tech companies are going to crash or anything like that, but it wouldn't surprise me if you see them just plateau a little bit and let everybody else kind of play catch-up.
Both can be true.
Both can be true.
Well, and again, if you're a growth-style company, you get rewarded for growth. That's it. You just have to grow. So by any means necessary. And if you're sitting at the head of the table and you're on the board, you got to do whatever you can. And again, with stock prices being way up, I would guess there's going to be a lot of small companies that end up just getting bought up because relatively speaking, it's really cheap to buy a $30 billion company right now. And $30 billion is huge. That's a really, really big company. Mm-hmm. But we're talking $3 trillion companies.
Right.
That's what 0.1% of their entire value. What did you say?
The video was up that yesterday.
Up what yesterday? Up what?
They were up. what do they have? 140.
I think you said 200 billion.
Well, they're up 7%. Help me with the math. They're up 7%, and they were at 2.5 trillion or 2.7 trillion.
So let's call it 180 billion dollars.
And we didn't even find any news. So they were up at McDonald's yesterday.
A whole McDonald's.
Yeah.
Today.
That it actually really does
Company, not store.
it puts it in good perspective, like how big these are and how things might have to change going.
But again, when you do these mergers and acquisitions, you lock in based on what the announcement deal is. And
it reminds me. I was just playing over the weekend. I was playing. Do you guys remember the old game of Risk?
Yeah.
Did you ever play it? I hadn't played it in like 30 years, and it was just like that. Once you start to get these armies, and you've got 35
Critical
armies in
mass.
front of you, and then my kid's got one little soldier holding up like, God, what was the country?
You cheated.
Ursurol, Kamchatka, and he's got one little soldier on it, and I'm coming in with 30. And he's got his one dice, and I've got like a pile of dice rolling over him. Like it's pretty easy to consume at that point.
Yeah.
We won't even go into why you were just dominating your kid in Risk.
In Risk.
He's got to learn strategy.
He's gonna learn one way or another.
All right. Well, I'm gonna stay with the no rate cuts. I know it's kind of boring, but so far it's one. And we had David Lebovitz on in November last year, and he actually thought there might be one or two rate hikes. So it just shows how things can change, month to month, and then nobody really knows which direction. We enjoy the prediction part, but it's for fun. And I think over the long run, we do understand reversion to the mean, and some of these things are going to happen. It's just somebody told me one time that it's not, you can be right, but your timing might be bad. And that's the thing about the market. Like if you're betting on things to happen now, they may not happen in the right amount of time. That's why over a long period of time is the best way to invest.